Hello, this is Jed Brewer with SG Voices and Study Groups. It's really nice to have you on our call today. We're going to be talking about credit and credit strategies and how do we grow our gallons through trade credit insurance. And we're all trying to grow our businesses, and we know as we grow our businesses, we face mounting pressure to extend credit out to our customers. It's through credit and terms that we can grow, but at the same time, we're trying to balance our cash position. So it can be a delicate balance to try to manage all that. So we have two experts here that are going to help step us through a little bit of that and how we can do a better job of growing our businesses. Really pleased to have Ann Pitts, who's the president of the Pitts Group. And Ann is going to be talking first about credit matters, leadership's role in supporting the credit department. So a few things that she's going to hit on is who should we have on our team? How do we build that A team in our credit department with the right people in the right role? So getting the right person in the right seat in the bus. And then what should those people be doing? So she'll get into specific credit staff duties that'll keep our businesses moving. And then also talking a little bit about what our team needs to do to mitigate credit risk in a high growth business. So I'm really looking forward to Ann's presentation. And then second would be Cory Watson, who's the VP of Trade and Business Insurance at Marsh McLennan Agency. Marsh McLennan is one of the larger insurance companies in the world, and Cory will be sharing what is trade credit, maybe a new word to some on the call here, and why do companies purchase it? Why is now an important time to be looking into this and balancing it? And if you already have trade credit, like what's your policy look like and how does that compare to others? So that's just a brief overview of what we're going to be talking about today. This conversation is going to be recorded. We'll send you the recording and the slides after this. And we're just really excited to have you on the call. We want it to be educational. And if you have questions, please type them into the GoToWebinar box, and I'll relay those to the speakers at the appropriate time. So with that in mind, Ann, I'm going to turn the floor over to you just to dive into more credit and trade credit and how we can ultimately grow our businesses and get that A+ credit department.
Great. Thanks, Jed. I appreciate the opportunity to be here with the study groups. My favorite people in the whole industry. So we'll get my slide deck going here, and just so you guys know, I'll just go through my story just a little bit. I'm actually an ex-banker. I was a banker in my career, and I made a move to a new area and went to work for a consulting firm that was working with petroleum marketers, and I was doing some work with M&A, which gave me a really close-up look at what your financial statements look like. And I'll tell you the truth, I was really shocked. You know, I didn't have any petroleum companies in my portfolio as a banker. I was kind of junior. I had a lot of other retail and things. I tell you what, I had people with a whole bigger markup than y'all do and bigger margins, but they were making candles and shoes and stuff like that. So I was pretty shocked when I got a look at your financial statements and I saw what really large businesses you operate. And I'm basing that off a lot of things, but certainly basing it off of your accounts receivable asset class. It was just really huge to me. And so in working with sellers, I really put a focus on, let's get your cash up, let's get your AR in better shape, and we'll be able to get more money for your business when you go out to market. And there were so many things that could be done within your own building, which is the good news, things within your own control. So that's been 12 years ago or so. I just started my own company, and that's what I do today. I work with you guys on credit policy strategy, staffing, staff training, all those things that, you know, equal and build up to a really efficient, well-rolling company. So,
and I see you note on here that you're a study group facilitator as well, Ann, and yeah, it's just been a privilege to have you on our facilitation team over the years.
Thank you. I love doing it. I love doing it. Yeah, so this is what I wanted to show you guys. This is a typical scenario that I would walk into where the owner would sit down with me and say, hey, you know, I got about 54 million in total AR, and I'm looking at the buckets and I'm saying, you know, you're 89% current. Now, this particular guy, I will never forget sitting in his office, very diversified business. He sold a little bit of everything. He didn't just have a book of business that was dealers, you know, that are on the 5-day EFT. So I'm saying 89% is looking pretty good. And, you know, 5% in that first bucket, we don't get heartburn over that. You could, but most people don't. The second bucket, things are getting stretched out a little. That's at 2%. Third bucket, we're getting the 30 and over. We're getting more concerned about that. That's at 3%. You get really worked up about the over 60, which is at 1%. So I was kind of complimenting him, and he stopped me right there. He said, that's not good. All right, Jed, go to the next little slide. He said, that's $6 million of my money that my customers are operating off on, and I don't have control over it. And not only are they using my money, but it's interest free. So why wouldn't they? And so that kind of gave me a different perspective, and not just look at the percent, but what kind of cash is floating around out there. And we'll go ahead and go to the next. And so here's another statistic as you think about, you know, I want to give you guys a big picture on dollars. What percentage of past due invoices are directly related to a failure in your own company? It is in your control. This is Credit Research Foundation number, not petroleum specific, but I'd be willing to bet that you guys have a higher number than this, and it's 67%. That is stuff that should be fixable, or at least be able to be worked on and made better. So that, if you look at that 6 million and you think about 67% of that, maybe we could fix it if we really, you know, put an initiative into it. And so that's some of the stuff that we're going to be talking about today. So we'll go to the next slide.
Yeah, it really begs the question, what do we do about it, right? And
what do we do about it? Yep, where's the root cause of all this stuff? So, you know, the first steps, building that credit department A team. It is possible. I have seen one person come in and make a big difference when you're talking about a credit team or just a department of one, getting the right person in there. What should they really be prioritizing and doing? What keeps the business moving, and what your team needs to manage and mitigate credit risk. And this is from leadership down. This number 3 is really aimed at leadership, and you're the ones that push that down. So we'll go to the next. A team, what do they get right? When I talk about a credit A team, yeah, go back to A team. I want to get real specific about this, so I'm going to look at some notes I've made. I'm talking about your credit manager, whether she's managing or he is managing a department of 5 or they're on their own. You need the right person in that seat. Then, you know, I hear people talking about, oh, I've got to find an experienced and somebody that's been in petroleum, and I wish you would train your brain to go away from that. It doesn't have to be full out experienced credit manager. They might bring some bad habits with them. They might come from an industry and not understand petroleum at all. It's trainable. It is very trainable. So what I'm going to encourage you guys to look more for is personality type, trainability, management skills, huge management skills. I've seen operation managers go into that credit role and just hit a home run. They knew how to manage business. They're going to be moving a lot or managing a lot of moving pieces and parts, which is really, really important. I recently wrote a study group voices article about personality traits. Some of these are, you've got to have a big backbone. Now you think about your person that's really leading up your team. Are they this person that we're describing here with a big background, not necessarily the sweetest, best customer service person around? Organizational skills. Great listener. They know how to ask a question and then be quiet and wait for the customer to carry that ball. So many times we just keep talking and you don't even give the customer a chance to answer your question. Part detective, researcher, able to deploy efficiencies. They must understand the priorities of the department. Organized and deliberate in execution. They are not afraid to push back. They are not yes people. They have big curiosities which cause them to want to dig in when they see something out of place. They need to be tech savvy, or at least willing to learn. And one of the biggest things that I can put on this list is they got to be efficient problem solvers. They know there's more than one way to skin a cat, and they're going to find a way to get there. And that's going to be helpful to your customers, and it's also going to be helpful to you to keep that credit risk mitigated, to really keep it down. So other employees in the department, they need to report up. They need to know they're reporting up to a person that's in charge. A lot of times I'll see 4 or 5 people in the department and they're all kind of on equal ground. It doesn't work as well. So they need to have a boss in the department that they report up to. So we'll go to the next one.
Yeah, Anna, just a question on that. How do you ascertain that right fit? Obviously an interview, but can you get all of that out of an interview or a resume, or do you recommend behavioral tests, or tell us a little bit more about that?
I think behavioral tests are important, and I think they're heavily used, or used correctly. But I also believe in the interview, actual what kind of personality you're looking, that you've got in front of you. Some of these stronger traits, you're going to be able to see it pretty quick. So I think a combination of really intensive interviewing and what's their background been, and do you have that management? Do you have that take charge? That with the personality test is a good metric to use. So you pay close attention to who you have in that role, because it's a really, really important seat to sit in. It's a hard seat to sit in. You're going to have to give them policy. You're going to have to tell them the way you want it to operate. Credit policy, you're going to have to define systems and get those really effective processes going for them. Okay, we'll go to the next. So you think about a football team, and you can't go out and win games without a really, really good game plan. That's what a credit policy is. It's a game plan to define everything that manages that growth. What I'm hearing, talking to people, that's one of the biggest challenges you guys have right now, is the big growth and managing that credit risk at the same time and keeping that cash flow where it needs to be. Next one. So what to include on the policy? Thank goodness I'm not going to sit here and read all this to y'all. I have no intention to do that. I want you to know the difference between a 3-page credit policy and a 15-page credit policy. All this needs to be in it. If you want a template of this, you just let me know. You can email me or call me, and I'll send you a template, and you go off and start writing. Next one. But a few things that I want to make sure that you have it in there is the detailed credit system flow. Employees need to understand how that flow. They need to understand the chain of command. They need to understand who they go to for what. If you have people, customers in that 60-day past due bucket, and you've got one credit manager working with them, not a good plan. I don't care how much of a gorilla the credit manager can be. You need to have 2 people working on it. You need to have the CFO involved, or the controller. Salespeople aren't the best heavy-handed collection people, but that's the chain of command I'm looking for. And I'm looking for authority levels in that same policy. I want to know, how much authority do I have to give credit for? I mean, am I supposed to be negotiating a 50 grand workout, or somebody else? This is stuff that I see confusion in when I go in and work with credit managers. Duty prioritization, they are putting out fires for everybody in the building. They're putting out fires with customers calling in. The first thing that falls off when they're putting all these fires out is the next one, which is collection effort. That's the thing that has to be that outbound call that nobody's banging on their door to talk to them about. They have to go out and seek it out. So all of these things need to be part of that policy that's just so important. Go to the next slide.
Yeah, and I was just going to ask you on that. You said on somebody who's way past due to have 2 people on it. What are the different things those 2 people are doing?
Well, you have one person that initiated the contact, that initiated the conversation. They're not getting anywhere. It doesn't make sense to let them continue it. They might take a back seat and let that next person come in. There's a more serious level of discussion when you get the CFO making the call. You still have the credit manager or the collection person working dovetailing, but you have to hand the baton to get a different result when you're being ignored, or broken promises, which are even worse. So
Let that customer give the out of, oh yeah, it got sent to my spam filter, I didn't see it or whatever.
you can only
The
say
new
that
voice.
so many times. Yeah, and it works only so many times. So correct. So I threw this in here because this is the kind of detail I like in a policy. When you're talking about, I've got a few customers that are 30-day terms. On day 5, I do this. On day 10, I do this. On day 13, I do that. It's very specific. Right below that, and I threw this in here for a little laugh, you got your COD customers. When they're 10 days past due, you do this. When they're 15, they do that. You guys are laughing because COD means they've already paid you. You have COD customers on your accounts receivable aging. I promise you, it happens everywhere. They migrate. Point I want to make, when you bring on a COD customer, make them fill out some paperwork, make them have a true credit file just like everybody else does, because you don't know when they're going to migrate. So we'll go to the next one. All right, so you got your person in place, you got your great credit manager in place, you've got some policy and procedures. What's next? The next one. This is the last thing you want, is just showing up to handle whatever anybody wants from you. I stuck this slide in there. It is true. When you interrupt someone, it takes them about 23, I think it says 23 minutes to get back to where they were. They are stressed more than they were, and the work quality drops. So to help combat that, next slide. Specific duties to keep the department moving. I put them in quadrants. I like quadrant 1 is urgent and important, do it. Quadrant 2, not urgent, but it's important, plan it. Quadrant 3, it's urgent, but not that important, delegate it. Quadrant 4, not urgent and not important, eliminate it. I promise all 4 of these are going on in many departments, but I'm talking about the credit department. So I'm going to get more specific. Go to the next slide. On quadrant 1, examples are credit holds. You've got people on hold. That's pretty urgent and important. They need to be researched, released, communicated, whatever needs to happen. That's pretty darn important. Another quadrant 1 would be collections, and that's not just looking at the aging and trying to figure out what's going on. Those are broken promises. Those are customers that have already been talked to, that have already not done what they said they were going to do. Salespeople need to be aware of this kind of activity. That's a quadrant 1, pretty important. Responses to critical communications that need to be handled first thing in the morning. So that can be from internal coworkers or external. That's 3 examples of quadrant 1. We'll go to quadrant 2, which is not urgent but important. Preparing KPIs for management meeting on Tuesday. That's not urgent, it's important. Performing 3 credit reviews, doing some proactive credit management on customers that are giving concern. Not urgent, important. Responses to critical communication that need to be responded to before the end of the day. That's not urgent always. That could be a salesperson that is calling to see why a credit app, he hasn't heard back on a approval or not. Well, it's because it was only halfway filled out. So that kind of thing, you can schedule those in to take care of before the end of the day. And the last one, quadrant 4, is, next slide. Not urgent, not important. This is happening in your department. Example, I got to balance the receipts from the company-sponsored kids soccer game that happened over the weekend, and I have to get it all to the bank by Monday at noon. Why is this the credit department? That is not urgent and not important. I'll tell you why it's the credit department. Go to the next slide. And this happens all throughout the building because we've always done it that way, because I've been balancing that soccer team since my kid was playing in soccer, and now he's 30 years old and I have grandkids. That's the way that works out. So we need to dig down and find out what people are doing and use the quadrant method to really help them understand their priorities. Next slide. They have a golden hour, guys. We all have a golden hour, and I believe it's in the beginning of the day. It always has been for me. That's when the really organized task-oriented credit people get their start on their quadrant 1 and starts hammering away on those things that really had to happen today in that first golden hour. The next slide. This is a quick thing I just want to throw out here, another time management exercise. Have your people go through this. Tell them this should take 10 minutes or less. Don't be overthinking. 3 duties you find are your highest and best use of your time. 2 duties you really love doing. These answers are going to surprise you if they're really honest about it. What's the one thing you should take off your plate? Don't worry about the who or the how. We'll figure that out. That's where that soccer team, concession stand, all that stuff that goes on that you have to do that's not urgent, not important. Those are the things you'll see when people go through this time management exercise. Next slide. So just some things that I see a lot that don't work well. You can think about it in your own company. New application turnaround time. Get down to the root cause. Why is it not being turned around? Could be that they're not being filled out well. They're getting to the credit department without, they got to be batted back and forth. Could be the references and the bank references are taking too long. If you're pulling a credit report and somebody looks A1, maybe you don't have to do those references. There's things to do to speed these things up. Not working well, a lot of times communication between sales and credits, they go back and forth through email, a lot of things get misunderstood, billing, invoicing errors resulting in slow pay. Who corrects those errors? There's always a little bit of heartburn over who does it. When it's easy for the credit person to do it, but it's initiated in another department, well, maybe the other department should get involved in correcting. Credit holds and slow sporadic collection efforts. These are things that I see in companies that are on fire, that need to have some attention. Next one. This is some things that your team needs to mitigate and manage top down. Next one, because I know you are all great study group, high growth companies. This is what I'd like to see you guys provide. Approve and roll out a detailed credit policy. It is not a do it once and done. It's a living, breathing document. It needs to be revised. It needs to be looked at. You need to make sure it's exhibiting of what's really happening, not just best case. Have some clear discussions about these in the weeds duties that the correct department might not even be doing them. Facilitate discussion between credit and sales on the app turnaround, on EFT. Are your salespeople selling EFT at the very beginning of the sales process? And other customer-oriented tasks. It just, leadership needs to get involved in some of these discussions. Next slide. Set authority levels for credit approvals, hold releases, and collection steps. Step back from swooping in, micromanaging, and then leaving, and then coming back, micromanaging and leaving. Give your employees the tools where they can do their own management. And then all you have to be aware of is the problem stuff. I like a weekly brief meeting with a specific agenda. You don't have to do this from now to the end of time. You might try it for 6 months or a year and see what you get out of it. I want to show you, next slide, what some agenda would look like. You know, review that aging, review those buckets. You don't have to talk about every single customer and take a long time. You might ask about the top 5 watch list each collector's keeping an eye on or has new things to report. I like to know how many applications were processed last week, how many were approved, how many were declined, what's pending. Talk about those pending ones or problematic credit decisions. Share credit reviews on customers that have been throwing off red flags. If you do this in a meeting, it really shouldn't be more than about a 30-minute. And my credit managers tell me it's one of the most helpful things that their leadership can do for them. Sit down with them, just, you know, bi-weekly or weekly, really important. Next one. Okay, resources. I want to give you this, and I can't believe I'm kind of rushed, but I'm going to be on time, I think. Credit department resources. Oh, looky here, credit insurance. Cory, I believe in credit insurance, not just because you're sitting here with me. It helps mitigate risk, helps you grow your receivables. It's not the credit insurance you might have looked at 10 years ago. It's way different. There's a lot of different stuff going on. Bectran is a great onboarding efficiency software you might take a look at. They have a new competitor called Nuvo, who's doing some new things. Another thing you might look at for that onboarding, you know, that front end of the credit process, it's so important. Bill Trust for managing receivables and helping manage collections. I've sat in some study group meetings and heard those guys win a great idea. So that's something to look at. Make sure you're using your back office software education or back office software tools sometimes we're way falling short on what's available, that we're just not using it, or we don't have that module set up. Offer your credit people continued education. If anybody's confused about options, again, let me know. I'd be happy to talk to your folks about other educational things they can get involved in. And final slide, I believe. Yeah, that's it. That's me. So we have a few minutes for questions. Jed, anybody have a question or?
Yeah, well, thank you, Ann. I appreciate you sharing that. I was curious on the credit meetings. Who all is in there from an organization would you recommend?
That's a great question. I like, of course, the credit manager, a collection person. If you have a specific collection person going up the ladder, they're going to report usually to the CFO. CFO needs, nice for them to be in there. I'll tell you the truth, it's nice for the sales manager, if you have a sales manager, to be in there if they can make the time. And somebody from leadership, it's nice for them to drop in when they can. You already have the CFO who's managing that department. But if a president or a VP or something can sit in once a month, it just keeps that communication in that no surprises realm.
Yeah, well, credit is so vital. I appreciate you taking the time to just step through that. And you even mentioned in there about one thing to keep your eye on is trade credit as a potential resource for your credit department. So it's a nice segue into Cory Watson, who's with MMA, to talk to us a little bit about trade credit and what we need. What is it? What do we need to know about it? And then how do our policies, if we have them, compare to others out there? So, Cory, I'll let you take it away.
Yeah, thanks, Jed. And it's always good presenting with you because I learned something, I think, every time I listen to you speak. I've been doing this 18 years and I've seen some good credit departments and bad, and it's a good reminder, I'll say trade credit, to start, is not really a replacement for a credit department. It's to run parallel with credit in general. But today we'll talk about, credit insurance and why I think it's important or even more imperative in today's market. There are folks on the call today that currently buy trade credit. There's folks that have never looked at trade credit, don't know what it is, and there's others that may have looked in the past, kicked the tires, but they never purchased it. So I'm going to chat briefly about, just in general, what is trade credit for those that don't know, reasons why companies buy trade credit. There's 3 or 4 reasons that are important. The types of programs and structures, and again, like Ann said, a lot's changed in the trade credit world. And now you can structure policies, and now why is a good time now to purchase. Trade credit, in short, is just an insurance policy that you purchase that guarantees your invoices are paid. You invoice the customer. If they don't pay the bill, you file a claim and the carrier pays it. This is it's a B2B transaction. It's for distributors, service providers, banks, all sorts of different industries. It protects you from losses, whether it's a slow payment, no payment. I want to pay the bill, but I can't. I don't want to pay the bill. Maybe my customer hasn't paid me, so I can't pay you. So whatever that reason is, trade credit will pick that up. It'll cover bankruptcies as well, Chapter 7, 11, 13, whether they're formal bankruptcies or informal. It covers preferential payments, which we've seen a lot in the last month, in my world anyways, up to 2 or 3 years for that, which is great. And it's a very flexible program, which I'll talk to you in just a second about how that works. When I say don't wait, or it's imperative, these are stats over here on the right. This should not be a surprise to anyone on the call, but the corporate bankruptcy filings, they hit a 14-year high in 2024, and then again in 2025. It's up 13% this year. So S&P Global, UScourts.gov, you can just look it all over. They're increasing. Still today, roughly 55% of B2B invoices are delinquent. 20% of businesses fail in the first year, almost 50 in 5 years, and 65 in the first 10. So, that's not to factor in all what's happening today with tariffs and interest rates and high prices of goods, regulations, the political climate that we're in as well. So in the trade credit space, loss ratios are up a lot. And then the ability to obtain coverage is harder. Capacity is shrinking. I'm a barbecuer and like camper, quite a bit, and I have a solo stove. And right now, that's a company that surprisingly is struggling. right now. So if I was in the business as I was selling to Solo Stove, you know, I would want coverage for that. Any struggling company. So to go out and get coverage on Solo Stove today is tough because there's not much capacity in the market for that, because that coverage has been eaten up. So when I talk about the demand for trade credit is up, the capacity is down in the market because of the claims that we're seeing.
And it's interesting when you talk about this general economic kind of variables you point out with bankruptcies up and so forth. I mean, we look at the stock market and it's hitting record highs, but there's a lot of negative things out there too, with tariffs and things that were many businesses under stress. So I hear your point that you're talking about it. When things make a turn for the worse, they can snowball quickly.
Yeah, it's not all bad. It's just, I think that you know, it's just it's a fairly inexpensive product to protect yourself from. You don't know what's going to happen in today's market, you know. So what do you do? Like you protect your most important asset, which is cash. So if you look at this pie chart, this is a typical commercial balance sheet where you have 40% of a commercial's assets are tied up in their accounts receivable, right? So you'll have a company and they don't think twice about insuring their inventories or machinery and equipment or their building, but they often don't insure their AR, which makes up the majority of their assets. And, you know, I would argue that you have a greater chance of filing a claim on a non-payment of a receivable than you would the fire insurance of your building. So it's sort of like, why do they not insure their AR? And I think, just on my experience, either they don't know about it, they don't know they can, or maybe they have a misconception of the product or the structure or how it works, or they think it's too expensive along that. So I'm going to speak to that just a little as we go forward. With these policies, you have third-party debt collection that's included. Sometimes they buy these, and you can save on attorney's fees or different collection costs as well. In addition to protecting yourself from losses, the sleep insurance part of trade credit, companies they really like the feature of information. So these policies, they come with data and different information on customers. So 100 million or more companies are monitored throughout the trade credit carriers, where they would look at a company and they may score them 1's the best, 10's bankrupt, or they'll assign some sort of score to them. They can be pretty valuable to a credit department. So they can run their traps and vet their customers, and they may pull their D&B or Experian or Credit Safe, whatever they're doing on the credit side. And this is another data point that you could put into a credit process that will help them make better decisions. And it's a guarantee on the receivable. So there could be some advantages to maybe reduce some of those subscriptions that you're paying for, and sort of overlay a credit insurance policy and use that data. So if you like the information, right, and you like the sleep insurance side of it, and a lot of folks will come in and say, you know what, I'm really buying this because I'm trying to grow the number of gallons that I have, and I need a tool for my sales folks and to ease some tension between, you know, my credit team and my sales folks. The sales folks want to sell as fast as they can. Like Ann said, halfway completed credit applications. In the credit department, you know, their job is to help grow revenue and protect the company as well. So trade credit is a really good bridge to help with that. This is a fuel distributor here in Texas. This is sort of an example where they had this portfolio of business, and they were very comfortable with the top customers, well-known companies, publicly traded or not. And they weren't worried about that. They were more concerned about the mid-tier customers, where they wanted to sell to them, they wanted to buy, but there wasn't a whole lot of data on those companies like there were on the larger companies. So this fuel company's comfort exposure was 50,000. Well, we went to market and got them 150,000 in cover. So that created an additional sales opportunity of $100,000. And at a 5% margin, some folks are laughing at this and some aren't, but that's the margin here, 5% profit margin, and they turn that every 30 days. They turn it 12 times a year. That's additional revenue of 1.2 million at 5%, $60,000 in profit. So that's a real simple example. In this policy here, this one account paid for the price of their policy. So they took this policy and they generated a return on investment with one deal, and they have scaled this throughout their entire portfolio and given it to their sales teams to say, could I vet or could I look up a company before I even contacted them to know how much cover I can get on that company? Because these policies have these databases and resources where I know going into a first meeting with a company how much credit I can give them, at least on the AR side. So it can be very, very powerful, very competitive when you're talking about growing gallons. So you have, the sleep insurance side of it. You have the information overlay that runs hand in hand with your credit department. You've got, could I make an ROI and sell more than what the policy costs in new gallons? And others will come and say, you know what, I'm really just buying it because I need better bank financing. So banks, as everyone here will know, they have rules. They have cross-aging language, and normally they will fund 75 or 80% on an asset-based line on receivables. They'll do an advance rate. But with trade credit, typically you can see up to 90% advance rate. So if you can get more money from that, you can also negotiate your rate when it comes to your line renewal, because you're taking some of that risk away where you have a policy, you name the bank beneficiary, and it takes away that risk, and you look much better in credit committee. It'll eliminate any concentration issues that you have. Banks tend to exclude certain receivables that are, say, 25% or more in the borrowing base. You can lump that back in. You can also include foreign AR, although you may not have a lot of it on this call. And it really helps just improve and save money on your borrowing base. So a lot of times that will alone make up for the cost of the policy. Industries and costs for these type of policies. It's not just fuel. I know we're talking fuel here, but trade credit carries over to manufacturing, wholesale, construction, different commodities, service-based providers. That's normally what we see. Types of programs, you can say, you know what, I've got clients that say part of our credit practice is we insure everyone. We want to underwrite to a zero loss ratio, zero. We do a partial portfolio that says, you know what, maybe I only want my top 10 insured, or maybe I only want my solar companies insured, or whatever segment you can do. Key accounts, you can say I want these 6 or 7 insured. Single buyer, the bank says it's concentrated, I want one company insured, you can do that. And then transactional that says, although rare, you can do that as well. So I just want one transaction insured. That's possible as well.
What conditions need to be met to do like a transactional one?
It's got to be large. So like we'll do like a ship full of raw crude, just a $20 million limit or something to one shipment, right? Or I'll sign a contract and I'm going to ship this in 6 months. Well, they need to know, can they finance that, or can they it's just for typically big transactions. If it's a $25,000 shipment to a C-store, they're not going to get a transactional policy.
Mm-hmm. And is there quite a bit of communication between the credit department of a petroleum marketer and let's say MMA, if they're buying the trade credit through you? With just a lot of back and forth, and even being able to get some help on evaluating the credit worthiness of a customer?
Yeah, we talk to, I'd say weekly, some every 2 days. There's meetings, live meetings, underwriter visits. It's truly they say it takes a village, but it's truly, we're a sounding board, because there's some things that clients can tell us that they wouldn't necessarily tell their credit insurer. So it's sort of a coordination between the credit insurance company, us to help facilitate it and sort it, and then the client has to be involved, because sometimes there's situations where I want a payment plan, or do you think he's going to pay me? What should I do? Should I file a claim or not? Or can you help source financials on this buyer? They don't want to talk to me, but maybe they'll talk to you because they don't want to share them with me. So there's a lot of that data, or hey, is this customer good or bad? I don't want to help them or not. Like, can you double check them and look them up? So that type of conversations we have all the time. From a cost side, I get asked this quite a bit. Hey, what's this cost, right? So It's not a hard question to answer, but I would say that traditional trade credit, again, this scales across multiple industries, not just fuel, but it would be a fraction of 1% of a client's annual sales, or a fraction of a penny per gallon. So we can back into that and have some examples here. So the average cost could be, and they're lower or higher, but 5 to 20 basis points of your insured sales, or roughly a third or less per gallon, a third of a penny per gallon. And you can sort of back into that with your own world. A lot of that depends on loss histories, the quality of your customers, the size of your business. So there's some stuff in there. But the deals we're writing now, we're seeing that pricing today in the market. It costs roughly 50 bucks to 100, let's say, to insure a $100,000 invoice or a roughly 50,000 gallons. That's kind of a round number you can look at too. Some examples, these are live examples that are in our portfolio right now. We have a company that does 26 million gallons. It's a fuel distributor. Their premium is $45,000. And that is, 0.0017 per gallon. So they can sort of back that in, and they can forecast when they're doing deals. They know exactly what that's going to be per gallon, and they can bake that into their deal. $100 million fuel distributor. This is a sales-based policy, not necessarily gallons-based, and it's 9 cents per 100. So it's $90,000 to insure 100 million worth of revenue. So when you're looking at other P&C policies, or you go to, the P&C world to insure your trucks and equipment, then a trade credit policy for 100 million is fairly inexpensive to insure that. In closing, I guess, if you're ever interested in looking, these are some questions you can kind of ask yourself: is trade credit right for me? If you have a bad debt reserve, if you're carrying a bad debt reserve, theoretically you could replace your bad debt reserve with a credit insurance policy that frees that money up, goes back into your balance sheet. Now you can forecast your losses because they won't be more than your trade credit policy. And at the end of the year, you can write that off as a tax deductible insurance provision. So it's a little different way of looking at bad debt reserves. If you have less than a 90% advance rate on your receivables, some clients here are well capitalized. It's not a big deal to them, but others, they would take advantage of that because, the more that you can buy, the more that you can sell, typically in the fuel world. Have you ever had a client not pay you, or they stretch you out for 30, 60, 90, 120 days? Like, how do you handle that? Are there some techniques? Could we leverage trade credit or some of Ann's techniques to help with that? So trade credit is a player if that's happening to you. If you're currently carrying trade credit, I know there's some on the call today, they're carrying trade credit. Well, it used to be 2 or 3 carriers carried this, and now we work with 20 or more, and there's new entrants coming to the market all the time. So many of these new carriers are non-cancelable. They won't cancel your limits mid-year. They have no credit limit fees. There's no true-up fees. When the price of fuel goes up, there's no fees. There's no co-insurance. It's 100% indemnity. You have some of that stuff in the market. It's not for everyone, but there is some uniqueness there. Or more supply. If you're having trouble getting more supply, maybe the terms are restrictive from your supplier, there's a way we could back engineer that, where basically you credit insure yourself to your supplier to allow you to get more supply with better terms. So there's some unique strategies there to leverage trade credit as well. That kind of gives you a rough idea. I have some questions if you have it, but I appreciate the time and the study group and all the members, as long as I've been a part of it.
Cory, another word that I hear thrown around in addition to credit insurance is factoring. Can you explain how those are different?
Yeah, so a factor will purchase your receivable, then they own it, right? So you're selling your receivable, and there's a recourse and non-recourse that says if the factor's not paid, they have the right to come back to you to collect the debt. Or there's other factors that say once you sell it to me, then you're off the hook. Most of the time, those factoring companies, they're backstopping it anyways with trade credit, right? So, a factor is going to charge you 1.5 to 2% per receivable per month, and a trade credit policy may be 9 basis points for the year. So it's dramatically cheaper, and then you're not selling your receivable. So, and it's just an insurance policy with a guarantee. So they get thrown around a bunch, but they're a little different. We work with factors all the time because we backstop their AR that they're buying from their clients.
Mm-hmm. Is there an approach that you'd recommend between those two for the typical petroleum marketer?
Well, from cash flow, I mean, trade credit can't really help you with cash flow. So I mean, I say it can. If you're a not bankable, let's say you're 2 years, or you don't have a 3-year mark, or if you're not bankable to the level that you want to be, then yeah, you can buy trade credit, and you can leverage that with a factoring company to reduce your rate with a factor. And you can use that factor, but the idea is to get you out of factoring with a traditional bank. So if you're currently factoring today, if we could wrap your receivables with a guarantee and then go to a bank, maybe you're bankable now, right? So you're giving up 24% interest on your AR to like a 6% line of credit, plus the cost of a policy. It's a no-brainer from an expense side.
Mm-hmm. Thank you, Cory. I appreciate that. And
yeah,
and one question that came in, Ann, getting back to you from the audience, but just kind of getting into the nitty gritty a little bit. So if all of a sudden you're collecting, and what's the best approach? Like, you call the AR person at the customer. Do you have a recommendation for what you should be saying to your credit team in that collection process?
I do. And I think you start with the accounts payable person, and you called in a friendly manner. Just say, hey, I'm checking up on invoice numbers so-and-so for this amount of money. It hasn't been paid. And then you be quiet. Remember, I told you you have to know how to listen and be quiet. Don't say, hey, did you not get the invoice? Or I've literally heard people, make a collection call and make an excuse for the customer in the first line or two out of their mouth. So a good collector lets them know that the invoice is outstanding, and then they're quiet. And then the customer will be the one that has to tell you what they're going to do about it. And you want to always make sure you nail down the plan. It will be here by what date? You're writing it down, and you're also going to follow up with an invoice if it's a big enough problem. This is what we discussed today. Look forward to getting your, ACH or your check by Wednesday. And if it doesn't come in by Wednesday, that's on that number one quadrant where you take care of that immediately. That golden hour of that day, you're following up on a broken promise.
Mm-hmm. Well, thank you, Ann. Go ahead.
I was just going to say, if you're not getting anywhere with the AP person, then that's when you have to escalate to a different level, and maybe someone in your company, what we talked about, the controller or the CFO escalates to calling their controller. This is a problem at this point.
It makes a lot of sense. And yeah, thank you for being on the call. I remember a study group member saying one time, yeah, we deliver fuel and all that, but really I'm a bank. And this credit and collections, and I mean, what we're making on each gallon of fuel that we're selling versus the cost of it. I mean, when things go bad, they go bad quickly, and we lose a lot of business. So yeah, we're in a risky business from a cash perspective. So what both of you guys have talked about, I think, is really germane to the core of what we're doing. So just want to say thank you again to Ann and Cory for what you've done. And then for the audience, for you, just want to remind you to check out our SG Voices website for more valuable content on there. We have articles, we have past webinars and other industry specific resources. And really, those are designed to help your businesses thrive. Also, want you to mark your calendars. October 23rd, we will have our next webinar, and Gravitate and PDS Solutions will be on it. So we'd love to see you there. And we just want to hear from you. So take a moment when you close out here off this screen. There'll be a very quick survey that pops up. We'd love your feedback on how we can improve these webinars and continue to make them relevant and value added to your company. So thank you again for being part of SG Voices. Have a wonderful day as summer draws to a close and the NFL season's picking up and all of that. So enjoy your time. See you next time. Goodbye.
Bye, guys. Thanks.